All right, my friends, we're now going to take a look at an example. And by the way, we're going to be using all of the information that we previously learned. We're going to look at, remember, the inventory that was $1.1 million and sold. It was sold for $1.1 million and it cost $1 million. Some of it's sold, some of it's still on hand. We're going to use that in this problem. We're going to take a look at the bond that was $250 face with a premium of $50,000, so a carrying amount of $300, sold back to the subsidiary for $275. There was a gain of $25,000. We're going to look at the land that literally was purchased for $200, that had a basis of $175. And then we're going to look at that machinery and equipment that was sold. And we're going to take a look at that, which was sold for $100,000 with a net book value of $70, $30,000 gain. We're going to have to also bring back the original 90 basis and accumulated depreciation of 20. So we're going to take all of those items that we've previously looked at, and now we're going to tie them in to this full-blown problem. So in January, Garrity acquired 100% of a subsidiary, and they issued 100,000 shares of their own par value stock. Now, do we use par value or do we use the fair value? Right, it's the fair value that we use. So on the acquisition date, the fair value was $25. So if we gave them 100,000 shares, that's $2.5 million is what we paid. That's the fair value of the shares we surrendered, $2.5 million. All right, let's continue on. On that date, the subs' assets and liabilities equal their respective amounts, except for a different piece of land. Don't confuse this with the piece of land that was transferred between the two. This is a different piece of land which had a fair value that exceeded its book value by $200,000. So that piece of land has to be written up by an extra $200,000. That's in the BIG, the BIG, the balance sheet adjustment. That's going to be the one item you'll see there. Then they tell us that they also had an identifiable intangible, R&D, $100,000. That's the BI, intangible assets, $100,000, and it should be amortized over 8 years. And then finally, they had net income of $350 and $150 in dividends. So under the equity method, we would have increased the investment account by $350 for the earnings, decreased it by the withdrawal of a dividend, $150. So that's going to impact the overall retained earnings over the course of the year. So at the end of the year, which is a very common exam trick, you bought the company at day one, January 1st, and then they say, here is the year-end balance sheet for the subsidiary. And you'll notice common stock is presumed not to have changed. APIC is presumed not to have changed. But retained earnings did change during the year. Earnings increased it, dividends decreased it. So that ending balance is not the balance of the CAR, the common stock, additional paid in capital and retained earnings, on the date we bought it. So we have to kind of work our way backwards. If the ending retained earnings is 500 and we back out the dividends and back out the income, beginning retained earnings must have been 300,000. Right, 300,000 plus earnings of 350 minus dividends of 150 would equal the 500. So now the CAR on the purchase date, 1 million for common stock, APIC 400,000, retained earnings 300,000. That's 1.7 million. Now let's stop for just a second. We paid 2.5 million. The CAR we bought on the purchase date has a book historical value of 1.7. There's an $800,000 difference. And by the way, there is no non-controlling interest. We bought 100%. So we're going to reconcile it through BIG. The balance sheet adjustment, which we learned in this case, is going to be the land is going to be written up. That's $200,000. Then we're going to have in-process R&D for another $100,000. And if that's all there is, what are we going to do with the remaining balance? That's right, we're going to plug it to goodwill. And that's exactly what we show you here on this slide. We have the book value, the CAR, the common stock, additional paid in capital and retained earnings, 1.7 million. We have our investment at the fair value of the shares we surrendered, 2.5, difference 800,000. We have no non-controlling interest. So therefore, we have a difference of 800,000 and BIG, the balance sheet, the intangibles, and goodwill have to explain it. We're told that land has a value of $200,000 more than the old owner's cost. Write it up to what we paid. Then we're told that intangibles, in-process R&D is there, but of course it's not on their books. They expensed it as incurred, but since we paid for it, we'll capitalize it, $100,000, and still there's a remaining $500,000 unexplained value. What do we plug it to? That's right, goodwill. So if you want to look at your little scale right here, you have your investment is $2.5 million. The book value was $1.7. They don't agree. We allocate as much as possible to the assets that need to be adjusted. That's $200. Still not in balance. Then we had $100,000 that went to in-process R&D. It's getting closer, but it's still not in balance. We needed an extra $500,000. And where are we going to put that? To goodwill. And therefore, your debits and credits will balance. And at the date of acquisition, this would have been the journal entry if you wanted to show a consolidation right away. You would eliminate the car of the sub on the purchase date against your investment at fair value. And then you would up the balance sheet by 200, create intangibles by 100, and plug goodwill for 500,000. So you get an idea of how the mechanics work. Now, let's go to the end of the year. What if we wanted to consolidate not then, but we want to consolidate at the end of the year? Well, then under those circumstances, we have to figure out what is our investment account. Our investment parallels the retained earnings of the sub. So if the sub had $350,000 of income going into retained earnings, we have $350,000 going into our investment in sub account. Then when they withdrew $150,000 and paid it as a dividend, we reduced it as a withdrawal from our investment account of $150,000. So our ending balance is $2,700,000. Notice what we've done is increased it by a net $200,000, which is also the change in retained earnings of the sub, a net $200,000. So if you wanted to do the end of the year, you would still eliminate the car, but now it would be the end of the year car, their common stock, their additional paid-in capital, and their year-end retained earnings, which went up by $200,000. And correspondingly, our investment account went up by $200,000, and it's being eliminated with a credit. And then the balance sheet adjustment is still the same, the intangibles are still the same, and the goodwill is still the same. So now you get an idea of how those kind of work together on a roll-forward year-by-year basis. Well, let's prepare the consolidated statement. And this is going to get into the weeds right here, where we're going to take all those intercompany transactions that we had in some of our previous modules, and we're going to show them as part of this process. So let's go through the income statement first, and we'll go line by line. Sales, and all I'm interested in is the eliminating debits and credits. All right, don't even worry. Where did we get the parent company's, income or the sub's income? Who cares? We're only interested in the elimination entries. You'll notice we're eliminating the intercompany sale of inventory, which was $1.1 million. And then we're eliminating the cost of the goods sold for $1 million, right? The net effect of that is a $100,000 difference. Where did we allocate that to? Well, $40,000 was sold and overstated, so we're going to reduce the $440,000 cost of goods sold to third parties. We're going to reduce that by the $40,000 that was an inflated price that the sub was showing when they sold it to outsiders. Then, where did we get the $12,500? Well, if you have an intangible in this case, in-process R&D, with an 8-year life, do the math, that's $12,500 that you are allowed to amortize. So that's a debit to the amortization expense. You'll notice where's the $3,000? That's reducing the depreciation. Remember the fixed asset that was overstated by $30,000 times 10 years or divided by 10 years. That was the $3,000 there of the depreciation expense. What about the $350? That was the earnings of the sub that would have been reported in equity and earnings, right? That would have been reported as income from sub. We're not going to show that as one line. We're going to show all the income itself. So you get rid of the equity and earnings. Then you can go down a little further. Gain on fixed asset. That $25,000 there is the difference between the $200,000 that it was sold intercompany versus the $175 of its original basis. So we're going to, in that case right there, we're going to look at it and we're going to adjust it accordingly. And then the 30,000 is the machinery, right? The machinery was sold for 100,000. It had a net book value of 70. 90 minus 20 accumulated. 90 minus 20 is a basis of 70, sold for 100, so therefore it was $30,000 that we said we have to, in that case, adjust for that. So we take that gain out. So we take the gain on the sale of land out, we take the gain on the sale of machinery out, and those are meaning that it's both debits. And then we also have, in this particular case, we had the bond. Remember, we actually bought the bond back and had a $25,000 transaction there. We have to eliminate that in this particular case. So the bond 300 versus the 275, that $25,000 difference is going to be eliminated. Then continuing on, we look at retained earnings. We look at the acquisition date retained earnings were $300,000. Remember, we backed into that. We have the net income numbers that we just came up with on the previous bit of information. Then we take dividends out of the actual subsidiary because we heard that they did pay a dividend of $150. Well, now we look at the balance sheet. And on the balance sheet, the very first thing is we have a receivable of $200,000 that we're eliminating. That was the $200,000 intercompany. And I believe that was the sale in this case. So we're eliminating that intercompany. I believe what they said was of the 1.1 million sale, 200,000 was still outstanding at the end of the year. Well, it's intercompany receivable. And down below under payables, you'll see we'll get rid of the payable by debiting it. So we're eliminating the intercompany receivable against the payable. You'll notice the 60,000 is in inventory. Remember, it was 1.1 million sale intercompany, $100,000 of really intercompany, bogus profit. Of that, 40,000 has been sold to the outside world. So you want to lower that 40,000 cost of goods sold, which we did. And now the 60,000 is still sitting in ending inventory as inflated inventory pricing. So we're lowering the ending inventory by that 60,000. The 60 and the 40 equal the $100,000 profit that was intercompany. You'll notice on the bond, we get rid of the outstanding bond by $275,000. It's been the investment in it, it's gone. We don't consider it because it's an intercompany investment in a bond. You'll notice we also have the fixed asset right here. The fixed asset, we had the 200,000 intercompany minus the 175. So in this particular case, we're going to show that. You'll notice also the 25,000 is that profit. And we're in this particular case, we're transacting and reducing the fixed assets by that 25,000 overstated amount. Then we're looking at, in this particular case, the wrong depreciation. So in this case, we're looking at that $3,000, and that would be an adjustment to the accumulated depreciation for the wrong amount. We then take a look at, we have, in this particular case, the indefinite-lived intangible. We paid for it, and part of big balance sheet adjustment, intangible assets created, goodwill plug. The I, that is the amount that we did pay, and we do create an intangible for the in-process R&D. And then, of course, we show the amortization of it as a reduction. Remember, you don't show an accumulated amortization. You just simply write off a direct amount. So you'll notice the intangible is now at 87.5. The goodwill was the plug. So we had that. Our investment in sub at the end of the period is the $2,700,000. So we can add up total assets. Accounts payable was the intercompany receivable, which we saw at the top of this slide, to the bottom, which is the inventory payable. So we'll eliminate that. We then have the bond payable, the $250, retire. By debiting a liability, you're eliminating it. And the premium, by debiting it, you're eliminating that as well. Then, of course, we eliminate the sub's common stock and their additional paid-in capital. So we have eliminated both of those. So how did those journal entries look? We highlighted them for you as I went through them. But what we're doing, again, to remind you, is we're eliminating the intercompany inventory of 1.1 million. We're offsetting that against the cost of the goods sold. 400,000 was sold, but they showed it at 440. So 40,000 was an overstated cost of goods sold. And of course, the inventory was overstated and we had to write it down by that, the 60,000. Then you had the R&D. We're going to show the amortization of that at 12.5. So we created the 12.5 and we amortized it. So therefore it's gone. We then showed you the accumulated depreciation was a number that the depreciation was wrong by 3,000. We do the car I'm in is big. And you can see there is the car I'm in is big. The car in this case was the 500, I'm sorry, the million, the 400 and the 500,000 from the subsidiary at year end. We eliminated our investment. We adjusted the balance sheet for the $200,000 worth of land. We created the intangible for 100,000 and the goodwill for 500. The land transaction, we got rid of the $25,000 gain and wrote that other piece of land down to 175. We had the equipment where we had the intercompany gain of 30 and we said, can't take that. So we eliminated that. We took that the machinery, and what we did was it should be at 90 gross. We were showing it at 100, so we wrote it down by 10, and we reestablished the accumulated depreciation of 20. The bond, we eliminate the bond payable and the premium. We then eliminate the investment in that bond by the subsidiary, and we literally, in this particular case, we do report a gain. A real gain is reported of 25,000. And then, of course, the accounts payable, accounts receivable that was still outstanding at year end on the intercompany inventory, according to the facts back then. So we eliminated that as well. A lot of stuff right there to look at. But you can see how if you follow step by step, you should be able to follow each of those items. And by doing this giant worksheet, we probably got a chance to review what we had looked at in some of the earlier modules and then tie it all in together. Obviously, this isn't something you look at once and say, got it. This is something you got to spend a little time with, work it, look it over, make sure you understand. Because reversing journal entries sometimes are the most confusing. You're going, well, why are we debiting gain? It's because we're reversing the gain. Or why are we crediting an expense? Because we're reversing an expense. Usually candidates, when they have a difficulty understanding why it's not a debit or a credit, it's usually because we're reversing, we're unwinding something. And that's the critical element you want to be aware of. All right, with that, you're ready to move on to our next module.